Index fund versus mutual fund is one of the highly debated topics right now. If you have money in an investment account, either it's for your retirement, your children's education, or as an investment amount, the options that investment brokers can offer can be a bit irresistible. Constantly, people ask us the difference between index funds and mutual funds, and which one to choose. Let's talk a little about the main features of these options and discuss which would be better for you. Before we dive into the details, smash that like button so that the videos will reach to a broader audience, and also subscribe to our channel to get notifications while we post a new video. Let's get started. Most of us as investors know the benefits of diversification. Investments in different asset classes reduce risk. Index funds and mutual funds are often preferred by investors to diversify their portfolio. So what is an index fund? Index funds are similar to mutual fund, but they follow the pattern of a market index, such as the S&P 500, or the Dow Jones, or Nifty 50. The purpose of these funds is only to duplicate or emulate the index. Let's explain this through an example. S&P 500 is the most common index that shows how the U.S. stock market is doing. They consist of top 500 U.S. companies by market cap. You have often heard people saying, "Today the market is down," or "Stock market gained 5% today." What they actually mean is that the S&P 500 index is down, or S&P 500 gained 5% today. So when you are investing in S&P 500 index fund, you are actually buying a fraction of those 500 companies. It is very easy to buy this way, rather than buying individual stocks, because the cost of investing in 500 companies on your own will be high. Does that mean that there's no cost in buying index fund? Absolutely not. Index fund, like mutual fund, have expenses to cover, but they are very negligible because there is no active management required. They are passive funds. Index fund managers does not have to research or analyze about a particular stock. They just have to invest in the companies according to the index. By investing in index fund, you believe that the overall sector or market will potentially gain value in the long run. For example, if you invest in the S&P 500, you believe that the U.S. stocks are going to gain value in future. If you invest in Nifty 50, you believe that overall Indian market will rise in the future. So what happens when a company is not performing well in an index? If any of these companies are not performing well, they will be kicked out, and the next best performer will be added to it. So you see, over the long run, you will always hold top companies. The mutual funds. Mutual funds are also called as managed funds. A mutual fund is simply an agreement in which a group of investors pool their money and hire a professional money manager to buy and sell securities on their behalf. These funds have a little more freedom in decisions about how to invest your money, but not much. These funds are intended to outperform the index and have a little freedom with a certain amount of their money in order to promise better performance. However, this comes at a cost. Mutual funds tend to have a higher administrative expenses than their index counterpart. The money manager or company withdraw an investment fee from the fund's assets each year, typically between 0.5% and 1.5%. It's called the expense ratio, and it comes directly from your account as a ratio of your assets. The investment company takes this money and uses it to cover overhead, office and marketing expenses, and to pay a custodian to handle the transactions. The money also pays a salary to the fund manager and a team of analysts who help the fund manager choose and buy stocks, bonds, and other securities to buy and sell. When you have a manager or a team of managers who actively buy and sell selected securities to maximize performance, minimize risk, or both, that approach is called active management. Looks pretty great, isn't it? The advantages of these funds is that they are likely to create more wealth than passively managed funds, and people feel a little bit calmer knowing that there is a manager who makes investment decisions for them. The downsides are that these managed funds are not likely to perform better than index funds. Consequently, these funds have charges that can completely eliminate the performance margin. For example, if an index fund has a return of 6% with an administrative cost of 0.004%, this would be a net return of 5.996%. If a managed fund similar to this has a yield of 6.7%, we could say that I earn more than the index fund, but the administration cost is 0.9% or more. There would be no benefit for the investor. Now, it is clear that by purchasing mutual funds, You benefit from instant diversification and asset allocation. However, the caution is that buying just a single mutual fund may not provide you with adequate diversification. It is important to check whether the fund is specific to a particular sector or industry. For example, investing only in an oil and energy mutual fund could spread your money across more than 50 companies. But if energy prices fall, your portfolio could suffer. So, which is better? Well, according to the latest reports, more than 80% of actively managed funds have failed to survive and beat their benchmarks over the long run, and it's really hard to always pick the remaining 20%. If you believe in stock market and the economy, the best strategy is to invest periodically in an index fund over the long term. This is also called buy and forget strategy. No matter what happens in the market, just keep buying because over the long run, index will always gain value. If you think that you have information that the market does not have, or that information reaches you faster than the mutual fund could provide you with an advantage, as long as the fund manager has this information. Many financial planners conclude that in reality, the type of fund you choose will not be the definitive factor in the return on your investments. What defines the return on your investments will be the different types of investments you have, like stocks, bonds, and real estate, the level of risk you're willing to take, and the period you are willing to hold. Having a diversified portfolio between different investment categories will be more important than whether the funds are index or mutual. So there you go. Now you know if index fund or mutual fund is better for you. If you like this video, give us a thumbs up and do subscribe to our channel to get updates on our new videos.